I would say the current state of the commercial real estate market is cautious but stable. The market has come to terms with the fact that higher interest rates are here for longer than expected. And that, coupled with inflation, have pushed up financing costs, making buyers more selective, both in terms of asset quality and basis. That said, CRE fundamentals overall have been resilient, and the asset class as a whole has seen demand return to the marketplace. In terms of commercial real estate transaction activity, we've seen a pickup in volume in Q1 2026, where sales are up over 30% from the same time a year ago. We've seen a bit of a slowdown in Q2, likely driven by what's going on in the Middle East. That said, as we look back at the first half of 2026, we saw an overall return of liquidity to the market and an improved dynamic of investor confidence. In terms of sector exposure, we continue to like the multifamily and industrial asset classes. Both sectors benefit from strong fundamentals post-COVID and have several positive macro growth trends that are supporting their growth. We believe that we are able to lend at valuations in today's market that are significantly below replacement costs and have cash equity in front of our position. It's true that there has been oversupply over the last couple of years, but we believe that absorption is now back and rent growth is returning. People often ask me how the market has changed over the last 3 to 5 years. I would say the biggest change in the market has been interest rate related. 5 years ago, ultra low interest rates and abundant capital led to the highest CRE transaction volumes on record. Since that time, we've seen a rapid repricing of interest rates, which has led to a decrease in overall valuations, where many of the pricing we're seeing today are 15 to 25% off of their peak prices of just 3 to 4 years ago. As a result, investors are starting to look at their overall strategies. Where there used to be a fight for high quality core assets in the marketplace, we are now seeing a bifurcation. On one end, you have several investors that are looking to credit as a replacement for those core equity strategies. On the other, we see a shift to more yield on the value add and opportunistic side of the equation. In particular, we really like the credit strategy, where you can start to get those equity-like returns with the current pay capital component embedded into those numbers. In terms of misconceptions around real estate, I think the common questions I get are around office or retail. And the biggest question is all office bad or are malls dead? I think everything that I've read and researched probably takes us, especially on the office side, out until 2030 before people think that we're going to get back to what maybe that pre-pandemic norm was, if we ever get back there. However, we are seeing differences across markets and across different types of office, right? Not all office is created equal. Specifically, we're seeing a return to office fundamentals in New York. We're also seeing that same return happening in San Francisco. And while we, from an equity investment perspective, are not quite ready to jump back on the bandwagon of office, we are more holistically looking at it from a real estate debt perspective, where we think we will begin to start to dip our toes back in the market.